Good afternoon, everyone. I welcome you all to ET Reality webinar. To present this webinar, I welcome Mr. Joe Verghese, Managing Director, Colliers International India, and share valuable insights on the topic Indian Real Estate Wrap-Up 2018 and Outlook 2019. There will be a presentation on the topic followed by a question and answer session wherein you may submit text questions to today's presenter by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We will collect those and address them during the end of the presentation. Now I request Mr. Joe Verghese to start the presentation. Over to you.
Thank you very much, and good afternoon to all. Welcome to the wrap-up of 2018 and the outlook for 2019 for Indian real estate. Sitting here, I can't stop thinking, where did 2018 go? And there were so many things that we had expected to happen in 2018, and did it all happen? So in summary, if you look at how I saw the year, especially while making through this presentation, was that it has been a year of transformation. Why do I say that? Why has it been a year of transformation? The Indian real estate industry is one of the biggest employers of our country after the agricultural sector. And if we take ourselves back to Jan 2017 and look at where we were in this industry, and look at what we were expecting the year to be, I would use one word. There was a state of confusion in the industry. We had just come out of one of the toughest periods in our industry, and I would like to just go back to that point and just show you where we were at that point, and then take it forward. So in terms of the agenda for this presentation, we are going to start with looking at that point, then spending some time looking through 2018 and what really happened in 2018 and what implications that had for us as developers, occupiers, and end users. And lastly, a little bit of crystal ball gazing to look at and give an outlook for 2019. That's probably going to be the best part. So when we look at the start of 2017 and where we are now in 2018, and look at all the macroeconomic indicators, and the most common ones, the GDP, the Sensex, and the one that has now become quite popular and hotly debated, the ease of doing business and our ranking there. It's quite amazing that in pretty much all these statistics, we have significantly improved. So at a macroeconomic level, we are actually doing pretty well. We are doing significantly better than we were in 2018. Now, various parts of this statistics could be debated, but there's two things that I want to just draw your attention on. They are a piece of statistic that not many people, especially in the real estate industry, look at. But I want to draw your attention because it has important significance from a perspective of end users, occupiers, and investors. The first one, the amount of investment that has gone into startups. At the end of 2017, when we were counting, we had collected close to $2 billion of investments in startups. As we speak right now, we are sitting at double that, $4.2 billion. And the second indicator that I want to just spend some time on is the amount of patents that have been filed in India. Why are these two indicators very important? For me, they are important because they are indicating that we are moving to the next phase of our growth. That is to a much more high-end knowledge-based economy. And I'll talk a little bit during my presentation about what impact that would have on real estate for occupiers, developers, and investors. So I started the presentation by saying this has been a year of transformation. And that's not from a perspective of policy change. In fact, in 2018 compared to 2016 and 17, the industry saw the least amount of policy change, except for the reform brought into the IBC code. Pretty much everything that the industry had asked for in terms of reforms in the industry had already been delivered by December 2017. And I also mentioned a point that there was a state of confusion when we got into 2018. The reason for that was that um, the industry was trying to grapple with the changes that were happening in the economy, the changes that were happening from a regulatory angle, and the changes that were happening in the industry. A few indicators point out that level of uncertainty. If you actually look at the amount of units in residential that were launched in end of 2017 compared to 2016, the number of units had dropped by 48%. If you look at the same indicator right now as we speak in December 2018, the number of units launched has gone up by 50%. So that is an indicator of how much confidence the sector has got back. And the second thing, it has learned to transform after understanding the impact of demonetization, after understanding the impact of RERA, and getting the better understanding of what implications the infrastructure status on housing would give them. So if we go back to 2000 to the beginning of 2018, it is important to understand where we came from before we go to where we are, before we get down to where we are going. And the first thing that I want to highlight from a perspective of changes that have happened in the economy, if you look at the year that has gone by, uh, when the real estate regulatory bill was brought in, it had an impact on the residential industry, which I spoke about. The number of launches dropped, the number of sold units dropped, and the average price dropped. And in terms of the GST that was launched in 2017, the rules that were brought in, while it brought an increase in direct taxpayer by about 50%, the impact over 2018 was significantly different. Sorry, I went a little too fast. Let's get back to residential sector and look at this much more better and much more clearer. If you look at the impact of launches, the launches have gone up by 51% compared to 2017. If you look at number of sold units, it's gone up by 15%. And the price, interestingly, though people keep saying the market has been stagnating or has gone down, on an average, it's actually gone up by 1%. So our view is that the market looks like it has turned, and developers have figured out how to play in the affordable segment, which is then indicated by the rise of the affordable segment supply by approximately 65%. Two other aspects that I would like to address over here is the industry has got used to GST, though it has implications on sales. It does look like the industry has got used to it. NBFC sector, that was one sector that was driving liquidity into the market, and which was growing by approximately 22% year on year. That's one sector that has had a bit of a slowdown in the end of this year. And while I won't get into the details of that, but it will definitely have an impact on our industry as we go into 2019. If you look at commercial real estate, and the impact all these changes has had on commercial real estate, that part of the industry has actually done very well. The gross absorption has actually grown. The gross absorption has actually grown from 2.8 in 2017. It's grown up to 11.6% in 2018. One significant difference in terms of the top three markets that have had higher absorption. The top three market last year the third market was Hyderabad after Bangalore and NCR. This year, Mumbai takes that spot. So that's a significant shift where Mumbai takes its rightful place. And the rentals, which was stable over 2017, are seeing a slight increase of approximately 2.2% on an average. Though they say the supply has dropped based on the number, I think it's not significant enough to talk over here. But a key point to talk about is the total amount of investments that have come into the commercial real estate industry. The compared to a decrease in 2017 of 27%, there's been a significant increase of more than 130%, with almost $3 billion being pumped into the commercial sector of the real estate industry in terms of investment. So a huge boost for the commercial sector, with new investors coming in, and a transformation taking place in terms of the owners of real estate. I'd like to spend a little bit of time talking about the implications of all these changes, and starting with the regulatory change. As I pointed out in an earlier slide, and as most of you in the real estate industry are aware, the last 3 years have seen more dramatic regulatory changes in our industry than we have seen over the last 10 years combined. And what impact has that had? If I break that impact down to the impact it's had for developers, investors, and end users, starting with developers, the 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 biggest impact it has had on investors in a positive way. So if you look at investors, whether it is RERA, which improves the transparency for them and makes it easier for them to invest in the market, because they know that there is more accountability among developers, or if you look at the IBC code, which gives them a venue for redressal in case of a bad debt or a bad investment, or the infrastructure status to funding, funding logistics, that has helped the industry look at that sector, that is the logistics sector, in a much more positive way. So if you look at it from a holistic perspective, all these regulations have actually improved the confidence of investors, which is reflected in the amount of investment that has come into this market to the tune of approximately $6 billion, half of it going into commercial real estate. And I think the regulations that we have put in place, or the changes that we have put in place the last 3 years, have played a huge role in increasing investor confidence. And that is kind of summarized in the slide in terms of what which regulation has had what impact. If you go to the next segment, and by end users that we are showing over here, we are referring to the end users of residential houses. They've enjoyed a dramatic shift in their power. That's what happened over the last 3 years, and I think they've actually seen that come to fruition in the year 2018. Be it in RERA, the number of cases that have been filed with RERA, and the number of convictions that have happened for developers where projects have got delayed, or where there was not financial prudence and corporate governance in the projects. Those have just increased dramatically over 2018, and you actually saw RERA, though not in the same wave across the country, but you actually saw RERA being a force to reckon with for the developer, and the developer looking at RERA as something that they have to be careful about. And the second thing that has happened is the power has shifted to the end users when it comes to at least the mid-end and the lower-end segment. The amount of launches that have happened in the affordable segment has increased dramatically, and I'll talk a little bit about the statistics there. But the government has given a huge push to affordable segment, and the industry has responded by increasing the number of launches of affordable segment to almost 51% of the number of launches that has happened across the whole year. These are two things that I think has had a huge impact, which has increased the bargaining power of the end user in our industry, and that transformation has again happened this year. One thing that's a bit of a disappointment, we were expecting the first REIT to get launched in 2018. However, the regulations are in place, and we are very optimistic that by early 2019 we should look at the first REIT getting launched. Now, if you go to the developer segment, I think if you compare the three segments, the investors, end users, and developers, um, the developers are probably the ones who've had to grapple with the most change, had to really transform their businesses, and have seen dramatic shift in their bargaining power in the industry. With RERA coming in, they have to watch out for ensuring that they stick to all the guidelines set by RERA. GST has impacted them because it has impacted the end price a consumer pays for under construction versus a fully constructed building, prompting them to get more liquidity through the project, through other avenues rather than relying on end users to fund them through the project. These are some of the changes, but there's been positives too. The impetus given by the government for the affordable housing sector, I think, has been a very positive move, and our industry in 2018 has responded very positively by launching more than 50% of their projects in this segment. So I think that's been a fantastic and great move for both the economy, the market, as well as the industry. As the industry, especially the developer segment, learns to operate in a new segment in the market. The last thing I want to point out is the entry of developers into logistics and warehousing. A lot of developers have seen that as a new area to diversify into. It's not an area that gives the kind of margins that the other sectors would give, but that's also kind of indicating the kind of margin expectations developers have come to realize would be a norm in this industry. And it's more about delivery accountability and delivering to the timeline that is gaining importance compared to just looking at projects that give the highest margin but may not give the volumes, such as luxury housing. So I've used this time to look at what the changes of the regulatory environment have done to all the players in the industry. And if I summarize the main transformation, it is that the bargaining power of the industry has actually shifted from developers and given the most flip to the investors, and the second most flip to the end users. And that's a good transformation, because I think everyone will recognize that it was unfairly skewed a lot towards developers in the early part of the industry, especially in between 2008 to 2015. So I think that transformation was good. And how did that impact our industry? I think what has happened over the last 1 year is that the tough people have got tougher, and we are going to see an environment where people who do not see real estate as a critical business that will transform their strategic outlook as an organization, a lot of them will start stepping out of that industry, because there will be need to invest in delivery, there will be need to invest in compliance, and it will no longer be a business that just guarantees you the kind of margins it used to guarantee just because you have access to capital and land. So the big transformation is going to happen in terms of execution and delivery in the next coming years, and that's what we are looking forward to. If you go back to the year that was in 2018, the big thing that has kept the industry going buoyant the way it has is the commercial sector. And the statistics on the slides will give you the reason why. The amount of supply that our markets have seen year on year is unprecedented. and not heard of in any other developed, definitely not developed, and nor in developing markets across cities. We have an average 48% increase in supply year on year over 2014 to 2017, and that's an amazing number. And the good news for us, at least, is that these indicators, especially absorption and supply, do not look like it is coming down, and it looks like the commercial real estate segment will continue to be the bedrock and give that stability to the industry, which the residential sector has not been able to provide over the last 4 to 5 years. If you go down into this sector and look at it from an occupier perspective, I think some of the trends we have started seeing is that the ITITS industry, in terms of its take up as a percentage to the overall take up, has started slowing down. So in the previous years, ITITS take up used to be approximately 66% to the overall take up. We are seeing that go down by 43%. But mind you, the overall absorption by the IT sector is still increasing. So it's not going down. It's just showing that the other sectors are picking up, and the sectors that are picking up primarily are the BFSI sectors, where we are seeing a lot more of the banking and financial institutions start taking up space. Uh, in terms of growth, in terms of game changers that have come into the market, the investment that I spoke about for startups are starting to see getting reflected in the absorption that is happening across markets. So a lot of the absorption in each of the markets are getting taken by startups and e-commerce. And that is only expected to grow as these companies grow in size and magnitude. And an interesting trend among occupiers as well as developers, because it takes shape across these two sectors, is the growth of co-working. The amount of space that is getting absorbed by co-working and that has been absorbed by co-working over the last 3 to 4 years, has grown up to about approximately 13% of the overall absorption. That is an interesting phenomenon, especially driven by the investments that are going into startups and e-commerce. So the landscape is definitely changing for our occupier. He's getting a lot more options, and the industry is definitely starting to tailor itself to the needs of the new occupiers, be it BFSI, startups, and e-commerce. So that's it from an occupier perspective. And if you look at it from a developer perspective, I think the slight cautiousness that was there that when developers looked at residential in the beginning of 2017 is starting to be seen even in the commercial sector in 2018. Why is that? I think this is the first time developers are starting to see a change in the market. It is no longer a simple IT/ITS client who has a basic criteria on what he's looking for space. Now the developer is looking at catering to sectors that require demand and require different specs, both in terms of quality, in terms of amenities, and developers are looking to differentiate themselves in the way they provide their services to the end user, which in the past used to be in a majority cases IT/ITS companies, but now they could be co-working spaces, they could be startups, they could be the BFSI sector, all of which are growing, and that is, I think, one of the big changes that are happening and developers are grappling with. Many developers are looking to transform themselves by getting into co-working businesses themselves, and a few developers have done that already, and a few are launching their products. So that I see as a change in the way developers are looking at the changing needs of an occupier and their demand for the end product, which is more experiential driven rather than pure cost driven. Cost was definitely a big criteria when IT/ITS companies looked at space. So that's, I think, one of the big changes that are happening. If we look at things from an investor's perspective, um, I think this is where a huge changes happen, starting with the ownership pattern. If you went back 5 to 6 years ago, the average investor for commercial stock used to be a retail investor who used to buy a small strata of a strata space in a commercial building, and each commercial building would have multiple strata investors. That has transformed significantly as developers have seen REITs as one way of exiting. So keeping stock to themselves and building a portfolio for the REIT has definitely been something developers are looking at, and many of them are transforming their operations for that. And to fund them in the interim, they are getting into joint ventures with funds or PE investors who would help them through the journey, with both of them looking at an exit from REIT. And the second transformation that has taken place is the amount of stock that has moved from just the ownership of the developers to institutional investors. That's going to be a important thing to watch out for, because in our view that will also have an impact on pricing. It will also have impact on the quality of the assets on an average we hold across markets. So it's a good sign. Of course, all of that will finally see a great outcome with the REITs getting launched next year, or at least the first REIT getting launched next year, with all the regulatory issues resolved this year. So overall, it's been a great year for investors in commercial real estate. They've been able to get the benefit of the stability that our economy and the market has had in that segment. So that's been the stable rock of our industry over the last 5 years. Moving from commercial to residential, I think it's important to dedicate some time on the big shift that has happened over the last 5 years. If you look at the changes the government has brought through its various budgets, every budget had some reform or incentive given to affordable housing. Affordable housing was clearly one of the biggest initiatives that the government had promised and delivered to a great extent in the last 4 years. So from the schemes that were launched for housing for all, as well as the financial credit disbursement under the schemes, I think all of them have had huge take up. The statistics are given in the slide, but a few things I just want to talk about were the amount of houses that were sanctioned under Housing for All in urban and rural, total hitting approximately 13 million units. That's a huge number when you take into consideration that prior to all these schemes, majority of our launches, close to 80 to 85% of our launches, used to be luxury or mid-income housing, comprising a smaller amount. But today, 45% of our launches, 45 to 50% of our launches are in the affordable segment. And according to the NHB data, close to 78% of the loans given out are in the category of less than 25 lakhs. And that's a big change from what the main focus for the financial industry as well as the developer industry had been 4 or 5 years ago. So a big change over here, and I think this has been the year where it has finally hit ground, and the launches have proven that the industry has learned how to deliver products in this segment, and the financial markets have learned how to price their product. And the economic reforms and the policies changes that the government has brought has all come together to deliver a product which is much needed in our country. In terms of what it has done for the end user, I spoke about RERA. I think the changes that RERA has brought has been significant from a perspective of shifting the bargaining power, as well as giving them a product that very rarely used to exist in the market, which is affordable housing, thanks to the policies that the government has rolled out over the last 4 years. For the developers, I think the last year has been the year that they have learned how to operate in a market, moving away from luxury launches and moving into a segment which they were not operating in earlier. That really required them to change pretty much every part of their organization that was gearing up, that used to deliver a product which is very different earlier. Not only that, they had to change their organization to make sure that every part of the organization, especially sales and finance, was geared for RERA. And talking about the finance division, it was further it was further made to go through some level of change with the changes in regulations in financial reporting, which required under the AS 115 law that revenue could only be booked once the projects were completed, rather than as the construction was going on. All these caused dramatic shifts for the better, but it definitely did cause some amount of pain, especially among developers who were not geared up for it and who were not ready for that change. In terms of investors, I think the year saw them looking at affordable housing as an area to invest in. All the investors saw this as a market that had huge potential, had huge demand. They were looking at developers who had the track record and the brand to deliver these products. And I think those developers who met those criteria got a lot of interest from investors for JVs, and to reduce the financial risk. JVs are something that we will, joint venture partnerships are something we see would continue to exist as we go into 2019. Now, as we go into other sectors, we looked at commercial and residential. I'd like to quickly touch on logistics. This was not a sector that we would talk a lot about in the past because the flavor always used to be residential for end users like you, and of course commercial, which was like a barometer to the economy, right? But the reforms and the incentives that the government has released, especially the Make in India policy, granting infrastructure status for the logistics sector, and as well as the amount of investment the government is putting into improving infrastructure, highways especially in the country, has given this sector a flip. And a couple of things have happened and have changed in the year 2018. From a developer perspective, a lot of developers have looked at this area as an area which could provide much more stability for them. And having got a hit in the residential sector, they have looked at this area as an area they could diversify into. So a lot of developers have started investing in building warehousing and infrastructure, industrial parks. From an occupier perspective, I think what was great is because the transformation in the industry led to new players coming into the industry, high-end developers and good quality developers delivering better products, and investors, marquee investors from international markets coming into the industry to ensure the standards of the product increase. The challenge, however, continues to be for the investors who have to play a very important role in ensuring that their product is priced at a point that it makes sense for an occupier. It is a very price sensitive market, and so to deliver a high quality product at that price, considering the fact that land values across even in the outskirts of major metros have not seen a dip, even with all that has happened in our industry. That has prove to be a challenge for investors looking to invest in this market. But that's not dampened the overall spirit among investors. We have seen the greatest increase in terms of investment over the last 4 years in this sector compared to the previous year. And out of the 6 billion, close to 1.8 billion dollars has been infused into this sector over the last 3 years since 2014. So it's definitely an industry that's starting to show some green shoots, and it's something to watch out for. And like affordable housing, though not in such a big way, industrial and logistics has definitely come to play as a segment and a sector to watch out for in real estate. With that, having gone through what 2018 was from a regulatory point of view, from a perspective of the commercial industry, from a perspective of residential industry and the industrial segment, we would like to now look at what 2019 would hold for us in all the same classes. We're going to take a shot at what success would look like for a few people who have braved it all. And I have to at this time give a lot of credit to all the industry players who have stuck through it and gone through all the challenges they have been facing, including the recent NBFC liquidity challenge we are currently facing, with a lot of courage and attitude that we have to learn from it and become stronger. So I think that's been the key in terms of the benefit that the industry has got. I think we have just become stronger. And if you look at 2019, we do not expect a huge amount of changes in terms of reforms because, as all of us know, 2019 will be an election year. But with the amount of supply that's coming into our markets, with the amount of absorption that's taking place in our market, our cities are truly becoming top cities of the world, at least in terms of the overall absorption as well as the size of the city in terms of commercial activity. So that's definitely happening when it comes to the commercial and from a regulatory point of view. And in the residential sector, I had spoken about power shifting to the hands of the end users, and I think that'll continue. And I think our take is that developers would become even more better at delivering affordable products. There would be huge investments made in the areas of construction technology to build products that would deliver high quality at prices that are sustainable for the affordable segment, and not only that, delivered in the timeline so that the margins are not eroded by interest costs or delays. We think that the industrial sector is a sector to watch for. It is not a sector that will give the kind of margins that developers have been enjoying, be it in commercial or residential, but it is definitely a sector that is going to see much more growth because of e-commerce and the impetus given by the government for manufacturing and industrial. So that's a sector we strongly believe is worth watching out for. We strongly encourage developers and investors to look at that sector as a sector to invest in. For developers and investors, look at some of the new areas they could look at investing as commercial and residential become mature segments in the market. We will see the tried and tested models being delivered and true leaders emerging among developers and investors in that market. The area where that has still not emerged, and we still have a long play before the real leader starts coming up, are in areas like senior living. India is going to have a huge population going up to about 300 million people in that would need to be catered to by the senior living segment. We do not see that many people getting into the market, and we believe in the next 2 3 years that's going to be an area that could be a game changer for developers entering new segment. Student housing, co-living, catering to the new millennials of our country, who are demanding new standards in the way they live and they work. These are areas that developers are actively looking at investing, and we're already starting to see investors also show signs to put down some capital and start seeing what kind of returns they can generate from here. There's been some changes from a regulatory perspective to promote data centers. Considering the amount of IT investments going into this market, the penetration of data centers vis-a-vis other markets are actually abysmally poor. So that's another huge area for investment, as we see for developers and investors. We had spoken about absorption and supply. I want to touch on how the rentals would change for commercial real estate as we go into 2019. The rentals we expect would start showing an increase. And the average rental across market today stands at approximately 80 rupees per square feet. We expect that to increase to about 84 to 85 rupees per square feet. So if I were an occupier, I would look at locking up my space. And this is primarily driven by not so much ITES, but by the new sectors coming into the market, startups, co-working players, and finally the e-commerce industry, where close to, like I mentioned, 10,000 startups are growing and building their requirement for bigger offices. If you look at the rental trends across markets, we are not expecting too much rental change in markets like NCR and Mumbai, but the biggest changes to happen in markets like Bangalore and Pune, reflecting the demand for higher quality delivery centers to be set up in these markets, where R&D for products, R&D for IT would locate to, and it is also reflective of the amount of supply coming in those markets compared to the average absorption that has been happening in those markets. In terms of trends to just watch out for, these have not started showing a game-changing impact as yet in our economy, but just like co-working did in the last 2 years, a few of these trends will start changing the way we do business. Blockchain making a huge impact in the way transactions and registrations are done in Andhra Pradesh. The use of drone and other areas of technology where decision making would become a lot more faster, and artificial intelligence and its impact on construction time, as well as the impact on occupancy of these buildings, are things that we need to watch out for, definitely for the future. I'm going to just spend a quick minute to talk about something that for us is a bit of a regret. We in late 2012, when we looked at the market, we had expected that sustainability would become a big factor when people build buildings. We have unfortunately not seen that growth. And with the level of consumer activism about pollution and the impact buildings have on the environment increasing, we think this is going to be something to watch out for. It's going to be something that'll be good for developers and investors to be prepared for. And while we are not seeing this as a primary focus, even among most occupiers when they look at buildings, we think this is going to change, and we are really hoping this would change. A few good things that are happening is the NGT is enforcing some very strong rules, while there are different views on the merits of these rules. But I think the message is going home to the developers that they have to take this seriously, and I think that's a good sign. And many governments are starting to give incentives for being sustainable. And last but not the least, a good green shoot is the fact that we are now the second highest ranking in terms of green building footprint. So I wanted to end that on that positive note in terms of the impact our industry is having on our community and what it should have. So with that, I would like to wrap up my presentation and open up the channel for any questions. Okay, I've got a question from Dr. Kishore, who is I can't see the questions. Okay, sorry, I lost that question. Suprajit, Subarajit has asked a question on the impact of the liquidity crunch on the real estate developers. Will they be able to complete the project or go for a new launch? Yes, this has been a fresh crisis that the industry has been grappling with, and I think yes, it will have an impact on the industry. There is currently a bit of a liquidity crunch, especially among the tier 2 developers in the industry, and we expect that to continue in the short term. Will that impact our industry in delaying projects? We see that happening for tier 2 developers, but not so much for tier 1 developers who are getting active inquiries to replace their debt from NBFCs. And so I don't think it'll affect them to a great extent. But I think a lot of projects that are held by tier 2 developers, tier 3 developers might actually start getting shifted to tier 1 developers, and they would take over to deliver them. So this will be probably the final leg that will see a transformation in the ecosystem in terms of the type of developers we have, the number of developers we have, and the number of projects each of them launch. So I think from that perspective, there will be a change. So I see there's another question on the impact of the IBC's rule on lending to real estate. I think, and this is by Vivek Gupta. I think it has increased investor confidence for sure. The introduction of the IBC rules has increased investor confidence, as well as end user confidence. Residential buyers today know that they are also in line if a particular project is taken to liquidation. So I believe that investor confidence in the industry has thereby increased, and that's reflected by the amount of investments that has come into the industry compared to 2017 versus 2018, which is, it's like I said, it's grown up by approximately 130%. With homeowners now being a member of COC, the enforcement capability of lenders have reduced considerably. I don't see a question there. Yeah, so that was more from a perspective of the earlier question. Sirish, why are residential sales not matching with commercial leasing pace, which is incremental growth? That's a very good question, Sirish, and I think that over the last 5 years, considering the absorption and the number of new jobs that have been created across the economy, the same should have got reflected in the residential services industry. Our take, or my take, on why that has not happened is because over the previous 10 years had resulted in significant amount of erosion of trust that end users had on developers in terms of delivery to quality, delivery on timeline, and delivery to promise. So even though supply was there, even though the buying power was there in the hands of the end users, they were hesitant. They were hesitant to go and sign the check, primarily because of this fear: will it get delivered? I think that has changed with RERA. I think the residential end users are coming into the market and starting to buy residential apartments, which is also seen in the statistics when we compare 2017 to 2018. Which region area has shown the highest number of launches in affordable housing? Uh, in terms of launches, we have seen most of the launches, interestingly, in tier one cities. Um, uh, so, and that's driven by two things. One, the interest among investors in tier one cities is the highest. So they have been funding developers who need the liquidity to go to develop products for the tier one cities. The second reason for that is basically the buying power of the clients in the tier one city is definitely much higher than the tier two city, and I think it's unquestionable that there is an untapped demand for this kind of houses in this city. So developers just had to figure out how to configure the spaces, how to size the product, as well as how to price the product to start launching into this market. And a lot of developers have seen a lot more success. I don't think that trend will continue for long, because a lot of investors as well as developers are starting to look at tier two cities, which are a lot more stable and also have demand for these houses. So I think in 2019 you will see a lot more launches in those markets. But in 2018 we've basically seen a lot more of these affordable housing launches happening in the tier one cities in terms of volumes and sizes. How exactly would REIT impact the commercial real estate industry? So REITs are a regulation or an avenue for investors of commercial real estate to get an exit that allows retail investors to participate in investing in commercial property, which earlier they could only do at much higher ticket sizes, and that too in a very unorganized manner in the form of strata purchases of commercial property. Now, with REITs coming into the market, developers will be able to exit out of the property at much better cap rates that they would hopefully at much better cap rates than they were getting in a very unorganized market, and the market would actually become a lot more efficient. So the pricing of the product would be dictated by market dynamics, which will be transparent, and it will also allow people who normally were not investing in these properties and needed much more higher capability to invest, to start investing in these properties. So I think that's one change from an investment perspective. From a quality of asset perspective, I think the quality of assets will start improving, because as institutional investors start taking over these properties, as asset managers make it their prime job to invest in assets and then increase the value of the assets so that the cap values keep improving, they will start looking at improving the quality of these buildings and improving the life cycle of these buildings. So from an occupier perspective, I think it gives them a much better product, and that's something to look forward to. Going forward, do you foresee increased M&A activity amongst the developer fraternity? I think we are already starting to see that. And while we may not see M&A activity happening at the main entity level, because when people look at real estate developers, they want to take the main asset that is of value, and the main asset that's of value in any portfolio of a developer is the land, and then the ability to construct and the ability to add some USPs or some differentiators into the product. Many of the entities that held a lot of this land have structures that may not be completely clear for a new investor to come in and take some of these entities. So we may not see M&A activity at entity level. We'll see a lot of land and projects moving hands from one entity to another, and that will happen in the form of SPV transfers, where these land parcels are located in. Will there be a supply-demand mismatch in commercial real estate as it has happened in residential space, now that attention of everyone is on commercial space? If that mismatch was supposed to happen, it would have happened already. But thanks to a couple of things, thanks to the fact that besides the growth of ITITS, a lot of in-house centers from Fortune 500 companies started relocating to India and investing in a much higher quality real estate, as well as paying higher rentals for this real estate. I think that was a major impetus. And like I mentioned, startups and e-commerce and they being catered by co-working spaces, all of them have played a very important role in ensuring that the absorption keep up to whatever supply is coming in the market. The vacancy levels across some of the markets are in double digits, but they are not yet worrying signs as yet, because for the last 5-6 years they have been at that level and developers have been working at that levels. So it doesn't create that amount of alarm. But in markets like Bangalore, in markets like Pune, we are starting to see that contract a bit. So we'll see prices increase in those markets for sure. Since India is focusing on affordable housing, the luxury buyer is investing in other countries like London, Australia, etc. What's your views about luxury industrial future in India? I think, and I'll have to take a shot at this. I think luxury residential investment is probably one area that will see a big boon in the market. Why do I say that? Like I said, most of the launches, in fact, all the launches that have been happening across major markets have been in the affordable segment. The supply of luxury housing has actually dwindled. Yes, the supply is much higher than the demand right now, but I also mentioned that the demand right now is not actual demand. Demand right now is driven by sentiments. The sentiments that the prices will not go up. The sentiment that the developer, if it's an under construction project, may not be able to deliver. These two sentiments play an important role in the investments that are going into luxury housing. But as that changes, I see that the price appreciation of luxury housing going up significantly, especially since supply of luxury housing in and around the city, even in the periphery, will actually reduce because a lot of the land has been taken over by affordable housing players and players building housing for the masses. So I think that's something to watch out for. The timing of that, whether it's going to be 2019 or 2020, will be anyone's take. How is PropTech going to affect the tier 1, tier 2 developers if it has a model to open up the dead inventories piled up with a drastically new sales model? I think PropTech overall will transform our industry, not just in sales, but in construction technology. I don't think PropTech will play a big role in improving confidence and improving the trust that end users have on developers delivering a product. So if you want to look at improving sales, I think the one thing you need to look at is, how do I improve the confidence among my end users, among my buyers, to buy my product and be confident that as a developer we will deliver. And if you're able to bridge that gap, I think sales, and many developers have started seeing that, sales start picking up significantly. NBFCs fill the financing gap with banks when banks weren't lending. With sales expected to remain slow at least for the next 18 months, how do you see the existing NBFC loans getting refinanced or repaid? Um, I think the phenomenon of liquidity crisis, I think, is a short-term one. While the tap has run dry, I don't think from a long-term perspective there is need to worry. Primarily because most of the loans that have been given by NBFCs are secured by land, and while there's been significant amount of financing, almost 22% increase year on year of NBFC funding of our industry, all have been done on the basis that a project is viable in a market where the projects have been having a tough time. True, there's been a lot of refinancing, but the underlying asset, as long as there's not been too much erosion in the value at that level, I think they will be able to retrieve a lot of their capital, and if the project sees the end of its life cycle, also make returns. So I see this as something that will unfold over the next 6 to 8 months. And in the meantime, for tier one and tier two developers, you'd have a lot of PE funds coming in to put in equity, where there's a good track record of delivery and sales. I'm getting a sign that we have run out of time, and I can see a lot of questions, but unfortunately, we won't be able to take all these questions. I would like to thank all our participants today, as well as ET Reality, for giving us this opportunity, and wishing you all the very best for the year 2019. Thank you very much.
Thank you, Mr. Joe Verghese, Managing Director, Colliers International India, for sharing valuable insights on the topic Indian Real Estate Wrap Up 2018 and Outlook 2019. Unfortunately, we won't be able to take all the questions due to time constraints. If you have any other questions, please send them at editor@etreality.com. It was an engaging and insightful talk, and hope all the participants have enjoyed this session. The recording of this webinar will be made available on etreality.com. Thank you everyone for joining us. Goodbye.